For July 14, 2026, welcome to the Economic News Desk. 1 month after its historic public debut, SpaceX shares have retreated 35% from their peak as investors pivot from hype toward valuation concerns. 1 month ago, SpaceX made history by going public, but the post-IPO honeymoon period appears to be over. According to the BBC, shares that once surged from an opening price of $305 to an intraday high of $255, briefly pushing the company's market value above giants like Amazon and Microsoft, have since retreated to around $455. That is a 35% drop from its peak. Recent volatility, including an 8% slide following Starlink price cuts in Memphis, suggests the market is moving past the hype and focusing more on valuation. This uncertainty is compounded by two looming factors for investors. First, the company is approaching its first public earnings report, expected in early August. Second, the market is bracing for the end of the employee lockup period. This will allow staff to sell their shares on the open market. While some investors are seeing significant gains, those who bought in during the first few days of trading are currently sitting on losses. Some analysts suggest the share price could dip as low as $115, which would bring the company's valuation down to $1.5 trillion. While high-tech markets deal with volatility, consumers in the UK are facing a more immediate inflationary pressure in their daily routines. The Guardian reports that coffee prices are climbing at a rate reminiscent of the recent spike in pub prices. In some areas, a simple flat white can now cost as much as $6.5. This isn't just a single-factor issue, it is a convergence of global and local economic pressures. El Niño weather patterns have dampened harvests, driving up the cost of beans, while ongoing geopolitical tensions in the Middle East have kept energy bills high. When you add in rising labor costs and higher tax burdens, the price of a daily coffee is being squeezed from every direction. We turn to the massive structural shifts occurring in the global automotive industry. Volkswagen Group is reportedly considering cutting up to 100,000 jobs worldwide, a figure that is double what the company had previously suggested. CEO Oliver Bloom is looking to bridge a significant gap in profitability. The company's operating profits fell to €8.9 billion last year, a steep drop from the €22.6 billion reported in 2023. The pressure on the German automaker is coming from two sides. In China, sales are declining, and in the United States, new tariffs on car imports are complicating trade. Meanwhile, Volkswagen is struggling to keep pace with Chinese manufacturers that benefit from much lower production costs and newer technology. Currently, Volkswagen's costs are roughly 20% higher than its primary rivals. To close that gap, the group is looking at massive cost-cutting measures. This could include closing factories in Germany, specifically electric vehicle plants in Zwickau and Emden. While some analysts suggest the 100,000 figure might be a negotiating tactic to secure better terms with labor unions, the underlying crisis in the German auto sector remains very real.